Assalamualaikum warahmatullahi wabarakatuh. So today my group will present about chapter 22, chapter Audit of Capital Acquisition and Repayment Cycle. So I will introduce to you guys about my group. First, Muhammad Nur Azwan bin NORANUAL, NURFARAH FAQIHAH binti AHMAD, Nur ALYA binti SAHAR, Siti Aisyah binti Mokhtar, Muhammad DANIAL Ashraf bin ZULKAFLY, and the last one, which is me, Nur Afifah binti Muhammad SYAHARUDIN. So let's go. But before that, I will tell about learning objective, which is after studying this chapter, we should be able to first identify the account and the unique characteristic of the capital acquisition and repayment cycle. For the second one, design and perform audit tests of notes payable and related account and transaction. The third one, we should be able to identify the primary concerns in the audit of owners' equity transaction. And the last one is we should be able to design and perform tests of control, substantive tests of transaction, and tests of detailed balance for capital stock and retained earning. Alright, so let's start with the characteristic of the capital acquisition and repayment cycle. So for this slide, I will explain about characteristic of the capital acquisition and repayment cycle. First one, relatively few transactions affect the account balance, but each transaction is often highly material. For the example is, bond is rarely issued, but the amount of bond issue is normally large. Auditor is responsible to verify the balance sheet account and transaction that occurred in the cycle for the entire year. Second, the exclusion or misstatement of a single transaction can be material. Auditor highlighted the most important part in auditing this account is often on the completeness and accuracy balance-related audit objective. Third one, a legal relationship exists between the client entity and the holder of the stock, bond or similar ownership document. So, the auditor must ensure that the client have followed the legal requirement of debt or equity agreement. If it affected the financial statement, client must adequately and presented and disclosed in the statement. The last one is a direct relationship exists between interest and dividend account and debt and equity. So, in the audit of interest-bearing debt, auditors should simultaneously verify and related interest expense and interest payable. It is also applied for owners. Next part, we continue with accounts in the cycle. So the first one is note payable. Note payable is the amount of principal due on a formal written promise to pay. For example, loan from bank. In addition, loans from banks are included in this account. So, number 2, mortgage payable. Mortgage payable is a liability account whose balance is the unpaid principal balance as of the balance sheet date. The amount of principal required to be paid within 12 months of the balance sheet date is reported as a current liability. The third one is contract payable. If you have a large project going on, do not rely on the payable report alone and do make list of all contractors on the project. The fourth, bond payable. Bond payable is a form of long-term debt. Bonds are issued by corporation, hospital and government. So, for example, public utilities will issue bond to help finance for a new electronic power plant. But in hospital, they usually issue bond maybe for new building or new equipment. About account in the cycle, number 5. Interest expenses. Interest expenses is non-operating expenses shown in the income statement. It represents interest payable on any type of borrowings, such as bond, loans, convertible debt, or line of credit. It is basically calculated as the interest rate times the outstanding principal amount of the debt. Next, accrued interest. Accrued interest is the amount of interest that has accumulated on a debt since the last interest payment date. 7. Treasury shares. Treasury shares is the portion of shares that a company keeps in their own treasury. Treasury shares may have come from a repurchase or buyback from shareholders, or it may have never been issued to the public in the first place. Number 8 is appropriation of retained earning. Appropriated retained earning or any unappropriated retained earning that are specifically do not be used for dividend payment. Retained earnings that have been set aside by action of the board of directors.
Thank you, Afifah. Now, my name is Siti Aisyah and I will be continue explaining the accounts in the cycle. The number 9 is the dividends declared, where when a company has issued a dividend payment but the payment has not been sent to the investors. The number 10 is the ordinary shares. Ordinary share is an equity instrument subordinate to all other equity classes. The holder of an ordinary share participant is an entity's profit only after all other types of shares has been participated. Number 11 is the preference shares. Consists of a company share with dividends that are paid to shareholders before ordinary shares dividends are paid out. And number 12 are the cash in bank. The sum of all coins, currency and cash items have been placed on deposit with a financial institution. Number 13 are the donated capital. It is a gift of asset to a company, usually by state or government, local government, to induce a business to relocate their jurisdiction. Part of shareholders, it is also a part of shareholders' equity, representing the fair market value of an asset at the time it was received as a gift. Number 14, the retained earnings. It is the profits that a company has earned to date, less any dividends or other distributions paid to the investors. Number 15, dividends payable. It is the dividends that a company's board of directors. Number 16 is the proprietorship capital account. It is a type of business entity that is owned and run by one natural person, and in which there is no legal distinction between the owner and the business. It is also the simplest business form under which one can operate a business and not a legal entity, and also a person who owns the business and is personally responsible for its debts. The last one is the partnership, the capital account, and equity account in the accounting records of partnership. The amount of money or other property that all the partners has contributed with the agreement of the others to the permanent endowment of the firm. Talk about the methodology for designing test of balance for payrolls liability. In this methodology, there are 3 phases. The first phase where the identification of client business risks affecting notes payable. Auditors often set tolerable misstatement and assess inherent risk for notes payable. This occur because it's really possible to completely audit the account balance and transaction affecting the notes payable account. Typically, they also set inherent risk at a low level because the correct account value is usually easy to determine. So the next phase, for the phase 2, there will be design and perform tests of control and substantive for capital acquisition and repayment cycle. And the last phase, the phase 3, they will design and perform analytical procedures for notes payable balance and design tests of detailed balance to satisfy balance related audit objective, which are including the audit procedure, sample size, item to select, and timing. Next, I will pass to my group mate.
Thank you, Afifah and Aisyah, for the explanation. My name is NURFARAH BINTI AHMAD, and I'm going to continue explaining to the next part, which is notes payable, together with my friends NORANUAL, ALYSSA binti SAHAR. First thing first, why is note payable? So according to the textbook, a note payable is a legal obligation to a creditor, or in the other words, a notes payable is a general ledger liability account in which a company records the face amounts of the promissory notes that have been insured. The examples of note payables is when a company purchases buildings, or obtaining a company's car, and receiving a loan from the bank. Notes payable may be unsecured or secured by asset, and it also bears with interest. And a note payable is issued commonly between 1 month or 1 year, but longer terms of notes payable are also exist. Basically, notes are issued for different purposes, and there are several property of the company that has been used to pledge as collateral. These include the wide variety of assets such as securities, account receivable, inventory, and the fixed assets of the company. Moreover, the principal and interest of note payables must be made according with the terms loan agreement. There are two loan periods, which is short-term period and long-term period. For the short-term period, it only required when the loan becomes due, and for the long-term period, which is over than 90 days, it is usually calls for monthly or quarterly interest payment. There are three objectives of the audit of the note payable. The first one is internal controls over note payables are adequate. So by having a proper internal controls over note payables, it will help the company to avoid any misstatement in recording the transactions of note payables, and it will also help the company to avoid any late payment or miss any payment past the due date that has been stated in the agreement. Second, the transactions are properly authorized and recorded according to the 6 transaction-related audit objective, which is the first one is existence, completeness, accuracy, posting and summarization, timing, and classification. And the third one is the related liabilities and expenses are properly stated according to the 7 of 8 balance-related audit objective, which is the first one is accuracy, existence, completeness, classification, cut-off, detailed tie-in, and rights and application. There are 4 internal control in notes payables. The first one is proper authorization for the issue of new notes. For every new issuance of new notes, it should be vested in the board of directors and high-level management personnel. Basically, there are 2 signatures of proper authorized that are required for all loan agreements, such as the stipulated amount of loan, the interest rate, the repayment terms, and the asset pledge. As when the notes are renewed, they need to be subject to the same authorization process as those for the issuance for the new notes. Second is adequate control over the repayments of principal and interest. The periodic payments of interest and principal should be subject to the controls in the acquisition and payment cycle. And at the time of the notes was issued, the accounting department should have receive a copy of note payable much like it received vendors' invoice and receiving reports. The accounts payable department should automatically be able to issue checks or electronic fund transfer for the notes payable when they become due. The third internal control is periodic independent verification. The detailed notes record should be periodically reconciled with the general ledger and be compared with the notes holders record by an employee who is not responsible for maintaining the details record. And at the same time, an independent person should recompute the interest as spent on notes payable to test the accuracy of the record keeping. Last but not least, the internal controls of notes payable that should be done is proper documents and records, which is these include the subsidiary records and control over blank and paid note payables by an authorized person. For example, the paid notes payable should be cancelled and retained under the custody of an authorized official. That's all for my explanation. Moving on to the next presenter, which is ALYSSA, who will be explaining more regarding the notes payable.
Assalamualaikum, my name is ALYSSA binti SAHAR. So I will proceed with the next slide, which is notes payable and the related interest account. So basically, when we borrow money, we debit cash and we credit payable. At some point, we are gonna make a payment, we are gonna credit cash, debit notes payable. Next, we are going to debit interest expense and credit interest payable to accrue the interest. I will proceed with the next slide, which is test of control and substantive test of transactions. Test of note payable transactions involve accurate recording of receipt from note proceeds and the repayment of principal and interest. Next is test of control for notes payable and related interest should emphasize testing the four internal controls. These tests are part of the test for cash receipt and cash disbursement. Additional tests of controls and substantive tests of control are often done as a part test of detail balance because of the materiality of individual transaction. In addition, the auditor should verify the accurate recording of receipt from note proceeds and payments of principal and interest. Okay, now I will proceed with the next slide, which is analytical procedure for notes payable. Substantive analytical procedures are essential for notes payable because test of details for interest expense and accrued interest can be often eliminated when results are favorable. The auditor's independent prediction of interest expense using average notes payable, outstanding and average interest rate help the auditor evaluate the reasonableness of interest expense and also test for omitted notes payable. If actual interest expense is materially larger than the auditor's estimate, one possible cause is recorded interest payments on unrecorded notes payable. For analytical procedures, we calculate approximate interest expense on the basis of average interest rates and overall monthly notes payable. For possible misstatement of interest expense and accrued interest or omission of a note payable. Next slide is for analytical procedure. Compare individual notes outstanding with those of the prior year and compare total balance in notes payable, interest expense and accrued interest with prior year balance. For possible misstatement, omission or misstatement of a note payable and misstatement of interest expense and accrued interest or notes payable. So I will proceed with the next slide, which is measure balance related audit objective in notes payable. The normal starting point for the audit of notes payable is a schedule of notes payable and accrued interest, which the auditor obtains from the client. When there are numerous transactions involving notes during the year, it may be impractical for auditors to obtain such a schedule. In those situations, auditors are likely to request the client to prepare a schedule of only those notes with unpaid balances at the end of the year, showing a description of each note, its ending balance and the interest payable at the end of the year, including the collateral and interest rate. The two most important balance-related audit objectives in notes payable are existing in notes payable are included, which is completeness, and notes payable in the schedule are accurately recorded, which is accuracy. The objectives are vital because a misstatement can be material if even one note is omitted or incorrect. When internal controls over notes payable are deficient, auditors may need to perform a standard procedure to test for omitted notes payable. For example, the auditor might send confirmation to creditors that have held notes from the client in the past but are not currently included in the notes payable schedule. The auditor might also analyze interest expense for payments to creditors that are not included in the notes payable schedule and review the minutes of the board of directors meetings for authorized but unrecorded notes. In addition to balance-related objectives, the four presentation and disclosure-related objectives are important for notes payable because accounting standards require that the footnotes adequately describe the terms of notes payable outstanding and the asset pledged as collateral for the loans. If the loans require significant restriction on the activities of the company, such as compensating balance provisions or restriction on the payment of dividends, this must also be disclosed in the footnotes. As auditors perform tests of details of balance for balance-related audit objective, the evidence obtained helps satisfy the notes payable presentation and disclosure objectives. So the next slide is types of audit tests for notes payable, which is example from XYZ company that is prepared by the client. So the next is also example from XYZ company. So that's all from me. Thank you. So I will pass to the next presenter.
we move to independent registrar and shares transfer agent. So any company with listed shares is required to engage an independent registrar as a control to prevent the improper issue of share certificates, and also to maintain the shareholders' record, including those documenting transfer of shares or ownership. There are two documents that we will usually use to audit on a security. So the first one is share capital certificate records, which is a record that the issuance of repurchase of share capital for the life of corporation. And the second one is shareholders share capital master file, which the records of the outstanding shares at any given time. Now we move to the next slide. Audit of share capital and paid capital. So this slide will explain to you the audit objective for audit share capital. The first one is existence. So any share capital transaction, we want to make sure any share capital transactions that have been recorded is actually occur. The second one, completeness. Recorded capital share transaction occur and are accurately recorded. And third, accuracy. Capital share is accurately recorded, and posting and summarization. Share capital is properly presented and disclosed. The next one, audit dividend. Okay, audit dividend. So the audit objective for audit of dividend is the first occurrence and existence, which is recorded dividends are actually occur, and dividends are paid to the shareholders that actually exist lah. And then second, completeness. So existing dividends are completely recorded, and dividend payables are recorded. So accuracy, dividends are accurately recorded, and dividend payables are accurately recorded. Now next is audit of retained earnings lah. So for most companies, the only transactions involving retained earnings are net earnings for the year, either profit or loss, and dividend declared. And second, I'm sorry for the typo over there, other changes in, it's actually number 2. Other changes in RE may include corrections of first, spiral period earnings, second, spiral period adjustment charge or credited to RE, and setting up or eliminations of appropriations of retained earnings. So that's all from us. Thank you very much.